everybody. Good afternoon. Hopefully you had some lunch and you've now got some sustenance to take you through the rest of the afternoon. As Mark mentioned, I am the National Distribution Manager here at LaTrobe Wealth, which is the asset management arm of LaTrobe Financial. Michael Watson was supposed to be here, but he did fall ill, rendering him unable to travel or present today. So I have been brought in to do this presentation for you very last minute. I will give you the caveat that I think this is my 8th week at LaTrobe and the first time, well, actually the second time delivering the presentation on short notice. So please be kind, and I'm not sure that we are actually going to have time for questions at the end, just given the amount of time I've been given. But what I can do is provide Mark and Cosette our contact details, and please, with any questions, do not hesitate to reach out and we will respond accordingly. So I'd really like to first take this opportunity to say thank you to Interprac for including LaTrobe Financial in your PD Days series, and we are very proud to be part of it, so thank you. LaTrobe Financial has a long history working with Interprac and advisors using our range of low volatility income products, and today's presentation will cover what I hope is some really interesting ground for you all, and through what amounts to quite a simple agenda. I'm going to start by introducing LaTrobe Financial at a corporate level and then at a portfolio level, so you can get a really good feel on how we've navigated the volatility of 2020 while continuing to deliver on our fundamental objective of low volatility income. I'll provide an economic update, including discussion around the property market, which is always a topical conversation, but I'm also going to have a look at the headwinds and tailwinds we see as important and potentially impactful on markets. Finally, I'm going to turn to an industry update with an overview of our sector, including key issues. What I'm going to do is I will take myself off video in a moment just because of my IT setup, and that I can then see the presentation that I'm presenting. And but please, if at any time the slides lag, just yell out and I'll make sure that I slow down and wait for the catch up. Our thesis around or throughout our thesis throughout remains that Australia is remarkably in a well-positioned recovery state. We've seen the V-shaped recovery, and that's exceeded all reasonable expectations. We're as I said, in a far better position than many thought possible, and Australians have benefited enormously, most especially through the incredibly robust recovery in employment data. For investors, though, the story's a little mixed. Asset prices are high and interest rates are low. That makes it incredibly difficult to generate consistent low volatility income. And at LaTrobe Financial, we're acutely aware of that dilemma, and we are leaning in to do our bit to help. So I'm going to explore some of these themes in today's presentation, and we're going to start with the corporate update. So just give me a moment while I remove my head. Now, we're moving to the corporate update. Can you see the corporate update slide? Okay, I'll take that as a yes. To start with, we're going to have a look at LaTrobe Financial Group and how we've positioned the business as of April 2021. Now I'm on the business summary. I think there are 4 key points about our business that every customer and partner should know. First, LaTrobe Financial has long been recognised as Australia's leading asset class specialist since we commenced operation in 1952. We have $12 billion in assets under management, and we now have 450 staff. And we're one of those companies that actually increased our staffing levels over the COVID period, even while we were in lockdown in Victoria. Secondly, our business has 2 key growth engines. Our asset management business is spearheaded by our $5.6 billion credit fund, which is underpinned by 51,000 investors, and it operates in the $3.2 trillion managed fund sector. Our real estate credit finance business draws on our deep expertise in credit to deliver one of the broadest mortgage product suites available in the $2.5 trillion residential and commercial mortgage market. Both markets have enormous depth and diversity and offer tremendous opportunities for us to grow and strengthen our offerings. Thirdly, both of these engines have been tested across many decades of operation. We have managed funds and built loan portfolios for many of the world's largest and most sophisticated banks, financial institutions, and fund managers. With an asset quality, the diversification and the portfolio construction disciplines to weather the ups and downs of the economic cycle. The 51,000 investors in the credit fund benefit from the same investment philosophy, the same disciplines, and the same expertise. Finally, we're a portfolio company of the New York-based Blackstone Group. Blackstone has over 619 billion US in assets under management and owns 75% of this business, with the remainder owned by senior management. Blackstone's global network of businesses give us real-time insights into market trends that complements the insight we derive from the circa 12 billion in assets we originate annually. And proudly, we are one of their best performing acquisitions, and they have not had to put in $1 to our operation. I've moved to the best diversified funding slide, so hopefully that's moved in time with me. A key point of difference, so we've moved forward. A key point of difference for our business is the diversity of our funding base. We have an unparalleled funding book spanning the world's largest banks and financial institutions, with whom we have $3.6 billion in mandates. We've issued $7 billion in RMBS bonds to the debt capital market. And of course, we have our $5.6 billion credit fund. Now, this profile is unique in the market and allows us to capitalise on growth and portfolio opportunities beyond those that our peers can pursue. And that's to the benefit of all of our investors. Let's have a look at the asset quality. Importantly, all growth opportunities that we pursue are pursued with an unwavering commitment to asset quality. The quality of our assets is what we are known for, and we are utterly focused on maintaining the very highest standards of investment and portfolio construction disciplines. On the screen, you can see that asset quality has improved materially as our business has grown. In June 2016, prime and super prime assets, and that's the highest quality loans we invest in, were 28.2% of the portfolio. At the end of March this year, that had grown to more than 38%. Conversely, the higher yielding but riskier specialist assets were 19.1% in 2016. They are now below 9%, so that's a 50% reduction. This is further evidence of the quality of our borrowers, and this can be seen from the average credit scores of our borrower applicants. Third-party data from Equifax, who provides the credit history reports we and most other lenders review as part of our credit assessment process, confirms that the average applicant to LaTrobe Financial has a materially higher credit score than that of our non-bank peer group. And in fact, earlier this year, the average credit score of our applicants even overtook that of the Big Four. After running neck and neck for the last 12 months, that's quite an achievement. And it's clear evidence of the quality of the borrowers in our portfolios and the rigour that we bring to all of our investment offerings. So let's have a look at the process built on experience. Let's take a moment to take a drink. Hopefully the tiles have all displayed themselves. Look, driving this operation is the deepest and most experienced and most expert leadership team in the industry. Our CEO and senior vice presidents have collectively over a century combined in the business, more than 17 years on average, and generally with extensive industry experience in finance, banking, and the law prior to joining LaTrobe Financial. We've built an incredible bench of industry and subject matter experts across all of the disciplines relevant to delivering the highest standards of performance for our investors, our borrowers, and our business partners. Their skills span credit to portfolio and liquidity management through risk and corporate governance, finance, treasury, collections, and much, much more. And we will continue to grow and develop our team to onboard the highest of caliber industry professionals who can continue to help us deliver the market-leading quality standards across our entire business. We're going to have a look at the environmental and social and corporate governance. And I know just, this is an area where increasingly we're seeing advisors and investors look for those, look to support those corporates that are doing really good things for the planet and doing good by the planet. And look, this has been for many years a very welcome focus on corporations contributing to society more broadly. And while we've always been very mission focused at LaTrobe Financial, these broader considerations, now generally summarised as ESG, have always been fundamental to our approach to business. Indeed, the notion of serving the underserved borrower, a social loan in today's language, is why we were founded way back in 1952. We know that the social licence under which we operate depends on us continuously renewing through our actions the reservoir of trust that we have built with our customers and business partners. And today we are proud to say we have a wholly integrated approach to ESG, and we look to by 2030 to eliminate our carbon footprint. So integrating environmental, social and governance. Hopefully you can see this slide now. Our governance framework has always been industrial strength and at the highest standards. That is a natural consequence, perhaps, of the breadth and sophistication of the investors for whom we've been managing money for 7 decades. We have an incredibly experienced and qualified board and a very strong culture of compliance organisation-wide. Our transparency is best in the market, and as you can see from the portfolio data we provide to the market each and every month, we have continued to deliver that month in, month out. At a social level, try that again. I think I've got someone else's teeth in today. At a social level, we are fiercely committed to remaining the values-based organisation founded by Ray O'Neill in 1952. We've donated over $16.2 million to various community charities and causes. And in the last year or so alone, we have donated $1 million to assist victims of the bushfires, another $1 million to the Epworth Hospital for coronavirus preparations, and up to $1 million for the customers affected by the recent floods. Let's have a look at the portfolio update. We're going to look at the credit fund and review the portfolio settings and performance as at the end of March. Okay, so product update. Our April portfolio snapshot and metrics report is on our website, and it's freely available to all of our investors and advisors. If you haven't seen it before, then I certainly recommend that you do have a troll through our website and have a look at the transparency, the depth of data, and the information that we provide to help you and your investors. And you'll note that it does give an incredibly detailed overview as to how the portfolio managers have positioned our portfolios. You can see all of our distribution rates, which are strong and which have remained incredibly consistent throughout the coronavirus event. That consistency is, of course, a consequence of the resilience of the underlying assets in the portfolio that I've spoken about and that I'll continue to draw attention to throughout the next few slides. You can also see key technical metrics that investment analysts use to assess the performance of the fund. So alpha measures, in non-technical language, that's their ability to beat the market. The Sharpe ratio and information ratios use 2 different methodologies to evaluate the risk-adjusted rate of return of investment portfolios, and they do that by using the risk-free and benchmark rates as baseline comparators. And all of these outcomes are incredibly strong and consistent and point to enduring outperformance of our offerings. So let's have a look at the fund AUM by account. Hopefully that screen's ticked over. So I'll take a sip of water. The fund's performance over time has been rewarded with strong net inflows. Anecdotally, we continue to hear from investors that consistent, low volatility income is in short supply, and I'm sure that's no surprise to any of you in the room. or from our WA participants. Our credit fund has a notable track record of meeting that need. You can see from the aggregate AUM and quarterly movement by account graphs that the credit fund has resumed its pre-pandemic growth trajectory and is up almost 15% year on year. That's well ahead of our expectations of 12 months ago. And I can share with you, April being one of our smaller or shorter and quieter months, we just ticked over 150 mil net flows. So that's just, again, another proof point that we are back at our pre-pandemic growth trajectory. Interestingly, the credit fund's componentry at an account level has also changed. The fund's average investment tenor is up to 8.2% as investments have tilted towards our 12-month and high yield accounts. That's a material improvement to our already strong liquid profile. And so that it has been a very welcome development, I should say. Finally, it would be remiss of me not to note that our 12-month term account has passed 4 billion in assets under management. It's been a terrific performer for investors since its inception in October 2002, and it's really pleasing to see the level of support it has received and continues to gain. Let's have a look at the geographically diverse nature of our funds. And geographically, our focus continues to be on the population hubs. Major city and eastern seaboard exposures are central here. Our portfolios are overwhelmingly in the metropolitan locations and in the major population centres. And that's going to continue to be our strategy for the foreseeable future. A little bit more of a granular deep dive here. And you can see that we're sectorally conservative. Those who have been following our webinars over the last 12 months will know that we very deliberately tilted our portfolios to residential loans through the COVID-19 period as an additional overlay of our conservatism. That served its purpose very well, and we're certainly happy now to see our commercial exposures start to rebuild. But please note, however, that our portfolios are built bottom up by an asset level. Now, that means that portfolio holdings move very organically and it's going to be some months before you would expect to see any substantial change in our portfolio holdings or trends. And we're very comfortable with that. We've had some questions around inner city apartment exposures. So you can see on screen that they are not material exposures for our portfolios. We've never been a big lender in that space. So moving forward, we're going to have a look at our overweight cash position. Hopefully the slides are keeping along my motor mouth. Our management bias is now very firmly to progressively reinvest the excess cash that we're holding in our short-dated classic and 90-day accounts. Once again, however, this will be done on an asset-by-asset basis, and we will not be rushed with this process. We will also continue to watch macro, market, and geopolitical developments to ensure that we have plenty of tactical optionality in our liquidity positioning. We remain one of the very few funds in the sector that have always met redemption requests in full at maturity, and we're entirely focused on retaining that track record across all our offerings. If that means we sit overweight cash at times, we're happy holders of that position. Just to give a little bit of background, during the GFC, we were one of a small handful and less than a handful of credit funds and mortgage funds that didn't freeze. We continue to meet the redemptions in full at maturity, and we continue to pay our monthly distributions. And again, we did that through the pandemic. All right, so we're moving through to the hardship slide, and just to show that it really is immaterial. Our portfolio managers are retaining the discipline of reporting on the loans in our portfolios in which borrowers are under pandemic-related hardship arrangements. You can see that each month in our snapshot and metrics report that we publicise on our internet page. Pleasingly, the rapid pace with which borrowers have returned to normal repayments means that hardship levels are now immaterial across the fund. And in fact, just 26 loans in total across a fund with 8,824 loans. Just as pleasingly, the transition from hardship to arrears has also been much less than expected, and we'll have a look at that next. Okay, so hopefully you can see the flood exposures and that it is minimal. We're pleased to be able to do our bit to assist the customers affected by the floods via the LaTrobe Foundation. And as I noted before, we set aside up to $1 million to provide grants to customers affected by the floods. Thankfully, so far, it appears that the impact on our book has been minimal, and in fact, just 2 affected loans in the credit fund experiencing temporary interruptions to business and cash flow. So no losses expected there at all. But on the back of a difficult year of bushfires and pandemics, our thoughts are certainly with those affected, and we will continue to do our bit to support the community and our customers. So moving along to the next slide, hopefully you can see arrears at our pre-pandemic levels that I've discussed. So remarkably, amidst all of this turmoil and disruption, and despite the fact that this time of the year is generally when we see the highest levels of arrears levels have continued their declining trend and are now around long-term averages across our book. We had been expecting 2 to 3 percentage points of hardship borrowers to transition into the longer-term arrears and workout status. So this outcome has been a very strong one indeed for investors. The especially pleasing part of this is that the new arrears loans are at an exceptionally low levels. Borrowers are transitioning out of hardship arrangements and in some cases off JobKeeper and are returning to their regular monthly repayments as scheduled. Now that's a testament to the resilience of our borrower cohort and also the strength of the economic rebound post-hibernation. Now as this year progresses, we'll work through the backlog of more aged arrears. So when we're talking aged arrears, think of those borrowers who went into default last year when the property market was effectively closed. So here in Victoria, we were in a prolonged lockdown. There was no auctions, there was no open houses, and that's what we're referring to there. Our mortgage help team will be working closely and sensitively with those borrowers, but as always, we will be prioritising the protection of the investor capital. Now, as the table on the right-hand side of the screen shows, asset impairments or shortfalls across the fund portfolios, both on a 1 and 3 year basis, are well below long-term averages. Now, that speaks to the quality of the book. While the 1 year numbers can move around a bit, the 3 year numbers are reflective of the overall improvement of asset quality in the book. Now, consistent income. I'll start talking. I am starting to run out of time. Finally, the bottom line during the month of March, so you can see on the bottom line, during the month of March, the portfolios continued to perform above benchmarks. That again is a consistent outcome since inception of our asset management operation back in 1990. The consistency of performance can be shown in the graph on your screens, which show the performance of 100,000 invested in October 2002 and compares it to a range of asset classes. Now, the dark blue line is cash, the green is property securities, the light blue is bonds, red is global shares, grey is Australian shares, and the purple is our classic notice account or our 48-hour notice account. The thick orange line is the 12-month term account, which I've mentioned started back in October 2002. The returns that it has delivered have been very strong, even in absolute terms, across the 18.5 years or 222 months period in which it has been operating. Its performance is also incredibly consistent or low in volatility, as you can see. It simply keeps on performing month in and month out and producing monthly income yields above market for investors. By contrast, our classic 90-day, 12-month and high-yield credit account continue their flawless track record. None of these accounts has ever lost a cent of investor capital or missed a distribution, as I mentioned before. None of them has ever failed to pay an investor redemption at maturity. Now, that's the performance profile we've designed over 7 decades for our investors. So we're going to move on to the economic and market outlook. Now, last year we were talking about the three phases of the pandemic economy. We were talking hibernation, when governments imposed lockdowns on society to curtail the spread of the virus. And then we're also looking at the rebound, the spike in activity that occurred post-hibernation. We also looked at the restructure, which is where we are now. The initial rebound has occurred and the economy is finding its new shape in the new world. Now, to be clear, the coronavirus is not finished. The vaccine program, as we've seen, is offering some hope, but it's also been halted and we've had some false starts. We're seeing recently the WA Perth lockdown, and then we're seeing a couple of COVID cases identified today in New South Wales, so stay tuned. But, you know, we can see... But these are, I guess, you know, as we're seeing now, these are going to continue to remain very real possibilities for us all. But the peak economic impact of COVID is probably behind us, and the world is now restructuring to find its new normal, which might be against a backdrop of residual pandemic risk. So economists are now more comfortable, actually. So I'll just... So I'm unable to actually see the title due to my computer. So hopefully you are seeing economists are now comfortable. But the recovery from hibernation in Australia has been V-shaped. It's been much quicker than any economist or commentator has expected, and it's been much more robust. Economists have spent the last 9 months continually upgrading their projections as data consistently comes in ahead of expectations. In mid-last year, it was commonplace to see projections of 12 to 15% unemployment and house prices down 20%. That sort of negativity has been well and truly reversed. While it would be a mistake to imagine that we're completely finished with the economic effects of the pandemic, it'd be foolish for us to ignore the fact that once again, the Australian economy has performed far better than any of us had reason to expect, and even very recently. So let's move into the property market where this is a clear example of the stronger than expected trend. So house prices are strong. House prices are growing at the fastest rate since October 1988. In March, they grew at an annualised 39%. Growth is uniform across all capitals and regions. Capitals are now once again outperforming regionals, but broadly speaking, house prices are surging across the nation, with Sydney the clear leader at an incredible plus 3.7% in March. What we are seeing is buyer demand is well ahead of supply. So hopefully you're seeing the slide, buyer demand outstripping supply. While listings are increasing, they simply can't keep up with the demand. We're seeing 1-for-1 sale for every new listing. That's leaving inventory levels, which you can see in the middle graph, at very low levels indeed, and is supportive of house price growth into the medium term. The outlook is strong. What's more, it looks like there's plenty of momentum in the current house pricing surge. Auction clearance rates are testing record highs, and prices are generally not that far beyond previous peaks. Take Sydney, for example, just 2.6% above its previous peak in July 2017. And the national level is not much stronger at just 5.6% higher than October 2017 levels. The test will come late this year and into 2022, when demand is likely to soften on the back of the pause in migration. In the meantime, our Council of Financial Regulators will be watching the monthly prints carefully to determine whether carefully calibrated macro-prudential regulation will have a role to play. It's quite a mouthful, that one. Just so we don't miss out on some of the pertinent information, let's move through the headwinds and tailwinds. We'll focus on some of the enduring themes here, and we're going to, as well as some new and interesting angles and insights. So the closed borders hitting migration. This is the first headwind, and it comes from closed borders and its effect on population growth and select industries like tourism and education. Remember that estimates now have Australia's population growth at its lowest rate in over 100 years. That's back to World War I. It's falling from 1.2% in FY20 to 0.2% in 21 and then 0.4% in FY22. This slower growth is mainly due to measures taken to limit the spread of COVID-19, which of course leads to the net overseas migration falling from around 154,000 people in 2020 to negative 72,000 in 21 and then around a negative 22,000 in 22. So when you sum all of that up, that's 402,000 missing Australians in just 2 years. You can see that feeding through into offshore student visa applications, which were down 65.3% in the year to 31st of December. And that's a significant headwind for what has been a really, or what have been really dynamic parts of the Australian economy over the last decade. The hair trigger lockdowns, hopefully that's coming through. As we alluded to before, last year it was Victoria and the extended phase 2 lockdown. And then we've seen nearly every mainland Australian state, including Victoria again, have some level of short lockdown on the back of minor coronavirus outbreaks. On the positive side, each of these have been targeted and has been for a short period of time, and perhaps that shows that our governments and authorities are developing some smarts around this issue. All of this will weigh on consumption, investment and employment, and the slower than expected vaccine rollout is absolutely not helping. So JobKeeper ended on the 28th of March and final payments were being processed by the ATO in April. This will undoubtedly affect some individuals, but at a macro level, it's hard to see it having much of an impact. Most income support has already been rolled off, as the graph on the left-hand side of your screen makes clear. And while it's been rolling off, we've had an incredible economic rebound. Job vacancies are at record levels. Unemployment has dropped to 5.6%, as we heard last week. And you've seen how our portfolios have been improving hardship and arrears levels. So we've got it as a headwind, an issue to watch, but base case, we're thinking this is just a natural bump in the road, or more of a bump in the road than a serious risk item for 2021. Look, the China trade tension, this fourth headwind is the most unpredictable, and it has the potential to be the longest lasting and most significant. In 2020 financial year, China made up 40% of our total exports, or $167 billion. That's about the same as our next 8 largest trading partners combined. Sadly, China has since announced a long list of trade restrictions on Australian products like wine, timber, sugar, barley, copper, ore, coal, and even lobsters. While these industries have felt the pinch, the overall impact on the Australian economy has been muted, and that's because of China's surging demand for our iron ore, which is 50% of exports. But that doesn't mean China is out of ammunition. In 2019, Australia earned around $12 billion from Chinese students, for example. While that industry has been put on hold post-coronavirus, it is by no means certain that the Chinese governments are going to allow its resumption when travel restrictions are lifted. So it's fair to say for Australia's economy, calming these trade tensions with China has to be a key priority. Tailwinds. We've talked about it already, but the strongest tailwind for the Australian economy is that incredible rebound from hibernation and the consequent surge across a range of economic indicators, including the all-important employment numbers. Now, our expectation is that the March quarter GDP will put the economy back above its pre-pandemic peak. At the end of December, it was down just 1.1% year on year. Just in the interest of time, I'm going to move through to Tailwind 2. If you've been privy to our previous webinars, we have discussed the whatever it takes approach that our governments and regulators have applied to the economic support provided through the pandemic. The fiscal response can be seen from the Treasury expenditure. The estimates on the graph on the right-hand side. Analysis puts the total fiscal stimulus in Australia at over 19% of GDP, which is the 4th highest in the G20 after Japan, the US and Germany. That's pretty incredible given the comparatively benign health outcomes that we've enjoyed versus many of our G20 peers. As if there was any doubt about the unanimous state of our policymakers, take a look at the April statement on monetary policy from the Reserve Bank. So the federal government is all in, the RBA is all in, and this is a serious, serious tailwind for the Australian economy. Look, just quickly on this one, in the interest of time, you know, the household balance sheets. Over the last 6 months, every mainland Australian state, including Victoria, sorry, I read another note, sorry about that, please bear with me. Yeah, so we've seen income support from the federal government coupled with a resilient economy and incredibly high saving ratios. You add record low interest rates taking pressure off mortgage repayments, and you can see in the middle graph what the result is. Household deposits have gone through the roof and are sitting well above 1.1 trillion. That is latent consumption just waiting to be unleashed, and it is another genuine economic tailwind. Look, looking at the broader economic impact arising from the surging house prices that we were discussing earlier, the wealth effect is an economic phenomenon that attracts a lot of attention. Put simply, the wealth effect arises because as people feel wealthier, they tend to spend more money. In other words, if you see the value of your house increasing, you tend to relax your spending disciplines a little. And when everyone across the economy does this, you can get a real and measurable increase in aggregate economic activity. So how strong is this effect? In 2019, the Reserve Bank published an analysis of the size of the wealth effect in the context of house prices. Its findings are on screen. In short, a 1% increase in housing wealth leads to a 0.16% increase in the long run level of consumption. That, by the way, is much stronger than the effect of stock market increases. So in summary, I'd like to finish with the headwinds and tailwinds. The headwinds our economy faces are real and substantial, but the progress already made, the commitment of our governments and regulators, the strength of our household balance sheets, and our strong property market are all significant and material drivers of our economy. Now, I'm going to have to, speed through the next few slides just in the interest of time. The back half of 2020 saw strong RMBS issuance, which saw the year as a whole and as one of the strongest ones over the last decade or so. That in itself is incredible on the back, not just of the pandemic, but the term funding facility and surge in household deposits, which resulted in our banks being incredibly well funded and having little need to go to the debt markets. The Structured Finance Support Fund has served its purpose of maintaining market confidence admirably, and the fact that it has deployed nothing like the $15 billion that was set aside for it shows to how fast and coordinated policy responses can actually reduce the cheque size ultimately required. As at the 31st of March, the availability period for the forbearance facility ended. That was the facility to cover the lenders for repayments that were not being received due to hardship arrangements. It's entirely appropriate, in our view, that the forbearance facility be ended, given there was really strong recovery for borrowers in hardship arrangements. I should note, for the record, that LaTrobe Financial did not make one application for hardship relief at any time. We nevertheless thought that the facility was very prudent policy making by our regulators at an incredibly volatile time in the market. So let's conclude by looking at the key issues. Our business is in excellent shape. Moments like the last 12 months reinforce to us the importance of emphasising a strong balance sheet and liquidity positions as a buffer against adverse market events. Our corporate balance sheet is in excellent shape and we're highly profitable. In fact, there was not a single month through the COVID period in which we didn't grow as a business, notwithstanding the market volatility. Our business model means that we are highly liquid and cash flow generative, and our capital position is strong and self-sustaining against the growth of the business. So we really are well positioned to continue to grow and develop as a business in the months and years ahead. We're looking at just quickly the official cash rate. We know that that's going to remain low, and looking at the cash flow, we're expected to see the no dynamic change in the official cash rate, until around 2024, and even that I think is ambitious. Borrower credit standards, given what's happening with house prices, we see credit standards as a likely focus of the Council of Financial Regulators over the next 24 to 36 months. So far, APRA data indicates that the banks have maintained vigilance here, and the CFR has confirmed that. Investor credit growth remains subdued, and riskier lending types like high LVR loans are still at low levels, I should say. But this will be a watching brief from now on, and you can expect to see lots of commentary on the issue. The regulatory environment, I guess the big ticket discussion point in the regulatory space at present is the federal government's proposal to replace the responsible lending laws and the National Consumer Credit Protection Act with the APRA lending standards in APG 220. I don't have a lot of time to cover that, but I might say we're in line to benefit in a minor way from some efficiencies around the technical and formal requirements of responsible lending. But the government has already stated the key elements of the APG 220 will apply to non-banks, and those standards are broadly consistent with ASIC's RG 209. What's more, those changes will apply across the market, so we will be competitively neutral. Look, I think we are just letting you know that we have a full team. Our BDMs are available to assist with whatever queries you may have, including your BDM in Adelaide, which is Dusty Reichard, and in WA, you have Andrew. So we also have a dedicated support team, and that's available on our 1-800 number that's publicly available. Look, it's really all we have time for today. I hope I've conveyed that the following key takeaways. Firstly, that the Australian economy, even against the backdrop of residual pandemic risk, is in great shape, far better than we had reason to expect even very recently. Secondly, while investors and advisors continue to face the dual challenges of low interest rates and high volatility, the asset class of secured property credit and our LaTrobe Australian Credit Fund has demonstrated remarkable resilience and continues to be a key provider of low volatility income for investors across all economic cycles. Again, I really thank you for your time, consideration and patience having me here in what is yet another Zoom presentation for you.